Right. I just want to thank everybody for coming to turn my camera off. Hi, everybody. This is Ray, specialist here at HEDCO. I just want to thank you all for taking the time out of your busy days to join us. I have Mark St. Pierre from People's Bank who's going to give us some inside information on how to assess capital as a small business owner. Thank you, Mark.
You're welcome. And actually, so it's the legal inside information, not the illegal kind of the fame of the 80s and early 90s. But anyway, my name is Mark St. Pierre. I'm the Vice President of Business Banking for People's Bank. Happy to be here. Thank you, HEDCO, for providing me this opportunity because it is one of my elements of my job, but it's also a passion to disseminate this information to the small business community because as an industry, we do not do a good job of communicating what's available to the small business market. So thank you. And if you are a business owner and have a business in Connecticut, then I encourage you to meet up with HEDCO if you haven't already, because they provide amazing services, not just lending, as we'll talk about later on in the presentation, but tremendous wraparound services around networking, around the fundamentals of each area of your business. They have business advisors that can provide a lot of valuable information, that can be at your fingertips. And that's one of the themes that I'll carry through the presentation is that aside from making the numbers work, you really have to be aware of the players in the space in terms of lending, and not just the banks, but the professional organizations like the HEDCOs that can help you out as you go along your journey. So thank you again. So I'll just go in my next slide. So a little bit about People's Bank. We're headquartered in Holyoke, Massachusetts. We're a $6 billion mutual bank. And what that means is that our depositors own our bank. So, at this particular point in time, our catchphrase is we're not going to be bought by anybody. But if anybody's been in the marketplace a long time, eventually probably something like that will happen. But that usually is around the $10 billion to $11 billion asset level. And there's a segmentation of banks that we'll talk about that, knowing what size the bank is can be a strategic level of awareness as you go to apply for a loan. So we're old. I do have gray hair, but I was not there in 1885 when the bank was incorporated up in Massachusetts. We have 21 banking centers. I say quote unquote branches because I'm old school and that's what they were called, but I get yelled at all the time that they're called banking centers now. And really, with the evolution of technology, it's there's hoteling opportunities in our branches for our customers, both personal and business. And so it's more of an informational hub versus what used to be more of a transactional hub. We have 8 in Connecticut, West Hartford, South Windsor, East Granby, Suffield, Avon, Glastonbury, and soon Hartford and Bloomfield. So in Hartford, we'll actually have a corporate headquarters as well as a banking center. So we're excited about that. And you probably have heard that the former Civic Center is now called the People's Bank Arena. And that's been getting huge accolades with the renovations that were done. We're happy to be part of that hub in Hartford. So who am I and why do I have the ability to stand here? Despite 12 years of teaching in the Hartford Public Schools, I have about 20 years of banking industry, mostly in Hartford County, both as a commercial lender and a business banking lender. And I'll talk about the differences associated with that. It's primarily dollar size of the loan, but it's also different information that you'd have to provide if you're speaking to a commercial lender versus a business banker. That's my dog, Chloe, and then my 5 children that we have there. They're everything to me, and I live in Newington, and I'm going to share some of that experience to you. So thank you. So you want me to talk about loans and the monetary aspect of it, but I want to approach it a little bit differently from the types of capital that a business employs. There's human capital, which are your employees, whether they're 1099, which is off balance sheet, or whether they're W-2. It's a level of responsibility and also could be a need for the loan dollars that we're talking about. The financial capital, could be equity, could be loans, and it could be loans from yourself to the company. And just a little bit of my background too, that is going to be sprinkled through here is that I've worked with every side of the balance sheet of a business, and the balance sheet is your assets minus your liabilities, which equals the net worth of the company. And on the liability side, you have loans, which could be the typical line of credit that we'll go through, could be a term loan or a commercial mortgage, and then you have equity, and that means bringing on equity investors into your company, but you also give up a piece of that equity when you bring those dollars in. So I have experience on all sides of that side of the balance sheet. Then you have your physical capital, right? It could be your buildings, your trucks, whatever you capitalize on your balance sheet from a fixed asset point of view, that is your physical capital. And we'll talk about, various loans that could support that as well. But I wanted to mention to you throughout this presentation, which is so important. I started off by saying we do not do a great job of disseminating the information about how to obtain a small business loan. And one way that you can take a little bit of control in that is building what I call your social capital. And just being on this presentation and taking and investing your time relative to this hour to learn about some of the programs, that's improving your social capital. So is networking at trade shows, SBA expos that happen, every quarter in different parts of the state of Connecticut, and I'm sure elsewhere if you're living outside of Connecticut. And then you need to maintain, I strongly encourage you to invest your time and money into CPAs, lawyers, insurance agents. These professionals have their network of bankers and access to capital that would prove very valuable to you as you go through this process. Trade associations and bankers. Every bank has its lenders, whether they're business bankers or they're commercial lenders. And you'll see them at various events like Chamber of Commerce, any kind of trade association like the CBIA here in Connecticut, at HEDCO events, and going around and networking and just introducing yourself and asking some questions like, hey, what do you look at when you're analyzing a loan, or are there industries that you particularly don't want to lend into? At these events, they're informal, but you can make a tremendous impression as it relates to just generating a relationship with a lender that when you go back to them, they know you, they know your story, and it makes the application process go a little bit smoother. So I know small business owners are so busy, right? They're doing multiple functions in their company, wearing all these hats, and no one has time to go out and invest in networking and developing a bench of with a CPA, lawyer, or insurance agent. But I strongly encourage it. If you're going through a loan application and the CPA knows the lender and can make a phone call to lend support, if the banker had any questions, it's just tremendous. And so investing in that branch of social capital will help you with your loan application. So please make the effort to do that. It'll help you in the long run. And I guess just to mention, we have a chat feature, right? That if you have any questions, please just put them in the chat. Okay, so this is a picture. I tried to think of a way to kind of match the sources of funds with the ultimate end game of getting a conventional bank loan, and I'm going to go through what that is. But think of it right now as a conventional bank loan would be a loan from People's Bank, Liberty Bank, TD Bank, M&T. That's kind of like the where everybody wants to aspire. And the reason for that is that I'm going to say to you that it's actually the least expensive form of debt, and I'll explain why. At the bottom, at the first step, you are just starting out as a company. You have savings, you might have some family funds, borrowing from, some type of trust that perhaps was created, or, just relying on that aunt or uncle to help you out. And why is that the most expensive? It could come with, some equity give up, which is, if everybody plans to be successful and that equity is going to be tremendously valuable at some point. But to give that up is a huge dollar amount. And also the emotional costs associated with, perhaps going to that Thanksgiving dinner or that barbecue and knowing that, your Aunt Sally, so to speak, put $50,000 into your company and she's asking questions about it. So, there's costs associated with that. As you go up the continuum, up the staircase, you might have some professional investors, some angel investors, which again, that's an equity play. And there's a network. You can use the internet to find out who these folks are. Some of them are industry specific, it could be manufacturing, it could be real estate, it could be construction, as an example. As you move up, you start to get into the alternative lenders. And, HEDCO is certainly, the one of the premier alternative lenders in Connecticut. And what does that mean? Basically, it's the alternative to conventional bank loans, meaning like there might be some element in your application that would preclude you from getting approved from like People's Bank, so to speak. So HEDCO actually would consider, lending under that opportunity with the caveat that they would provide services for you, with you, that would improve that, that element that precluded you from getting conventional bank loans. I have a slide later on in the presentation that lists some other organizations that that are available, and they're tremendous. And I encourage you to have conversations with those folks as well. Other alternative lenders, as you get up to that space, there's small business investment companies. They're called SBICs, and they're an extension of the SBA, which I'll also talk about. So when you get up the ladder in conventional bank loans, you see the time element. It takes 2 years. For example, People's Bank, we will not entertain your loan request if you are under 2 years old from your business. So once you reach, and a lot of banks have that in their underwriting guidelines. So, I mean, that's another, limiting factor in terms of the amount of time and investment that you have to make to get to that conventional bank loan perspective. And why is that the least expensive? When you're at that particular tranche of debt with like a loan from People's, we're relying on primarily the assets of the company that's been created, and there's a history of those assets like accounts receivable and inventory for the bank to get comfortable with. And as such, we charge a lower interest rate because the perceived risk is a little bit lower than if we lent to you when you were, 1 year from starting your company. So the time to get to the People's Banks of the world, the Liberty Banks of the world is very, very long. It could be 2, it could be 3 years, depending upon the elements of your business as it relates to the assets that you have in your business. And I'll talk about that in a couple seconds. So what are the typical business loans at the conventional level? You're looking at lines of credit, you're looking at term loans and commercial mortgages. In our world, our commercial mortgages are called owner-occupied mortgages because typically the business owner is the primary or only tenant that's in the building. Lines of credit are for your short-term needs. For example, you bill out your accounts receivable for your business, and the terms are 30 days, but your payroll is next week or Friday. And so a line of credit allows you to meet the payroll obligations while waiting for the collections on your accounts receivable. So a line of credit is meant to float up and down, much like maybe your personal credit card. They're usually granted for a year or up to 3 years, and they include financial covenants that you would have to meet. Those would include financial reporting requirements, which is then again important to have a CPA on your team, and some banks actually convert them into a term loan at the end of a 1 year or 3 year period. So you really need, with all these obligations, as you go through the process, you're going to want to read the loan agreement and the other disclosures that you have to sign. There's a lot of small print, and to not spend the time, one, for yourself to read it, but then two, have your legal counsel read it. present a significant issue as you go through the relationship with your banker. Term loans are for purchases that have a longer term useful life. For example, a truck for your business. It could be a van, a truck. It could be a CNC machine for your manufacturing milling operation. And typically those assets last, between 5 or 10 years. So a term loan would be repaid over those 5 to 10 years. Bankers always try to match the repayment of the loan with the economic life of the asset. So on a line of credit, it's short term because we're relying on accounts receivable and inventory, which should turn, every 30 to 45 days. Term loans are, the trucks and the CNC machine, which have a longer term payout. So thus, when you get to the commercial mortgage, when you're talking about a building that the business owner is purchasing, that's much like purchasing your own home. That could be 20, 25-year amortization, although differently than the residential side. When you buy your home, or if you're looking to buy a home, that's a 30-year. The loan is due on the last payment of your residential mortgage. A commercial mortgage is not that way. A commercial mortgage might have a 10-year term with a 20 to 25-year amortization. So what does that mean? You have a balloon payment at the end of that 10-year period that would have to be refinanced. It's a way for the bank to look at, the status of the company as it relates to, whether to extend that, and gives you the opportunity to go out to the market and perhaps get a better rate. So commercial mortgage is long-term, term loans, medium-term, lines of credit, short-term. So those are some of the types of business loans that the conventional market, can provide, as well as the alternative lenders. And so having that knowledge and being able to use those terms would show your lenders a level of sophistication. So investing time to learn up on that is extremely important. I went through the repayment cycles of these. Again, the line of credit is short-term, term loans are medium-term. The term loan payment could be structured like a mortgage, where you're paying principal and interest, or it could be structured where you're paying a straight line amortization plus interest. So again, you really want to look at how the bank is determining the repayment during that time frame. And commercial mortgages are 20 to 25 years. Just a tidbit, if at all possible, I highly recommend to the business owners that I work with that they own or try to own the building that they're in. It's probably going to be structured, off balance sheet in another entity, but it's an asset that can build over time for you. And from real estate point of view, and it also gives you a lot more control. If you're a tenant, in a leased space, you have to be concerned about what's going on with the landlord. If you're the landlord, then that eliminates that, and you have more control. And during those, rougher periods, you might could tap into the real estate equity to help your business. I'm seeing a lot of that. So just in terms of a market perspective right now, we're seeing a lot of owners tap back into the real estate value of their building to a couple of reasons. One, to repay, some shorter term debt with, a lower interest rate on the real estate, but also alternative investments. Think about it as a cash out refi on the residential side. We're doing cash out refis on the owner occupied side that could give liquidity, for the owner for multiple uses of funds. So owning the real estate that you're in I couldn't, very rarely do I not recommend it. So please look into that as you go through the course of owning and operating your business. So banks look at the market, People's Bank included. We try to streamline the underwriting process. The bank wants to make money. And, I'll talk about how we underwrite our loans. And it'll show you why we have to streamline on the smaller loans to make money. So at People's Bank, if you want to borrow $250,000 or more, up to $1 million, that's the business banking threshold, which is $250,000 up to $1 million in debt. We're going to get 2 years of tax returns, both you and the business. If you're a Schedule, C or Schedule E, then, just your personal one, and the business will show up on that. For your S corp, we're going to want the S corp financial tax return as well. You're also going to have to create a personal financial statement, which is a bank form that are pretty consistent with each bank, but it's going to list your assets, your liabilities, your cash flow. It's going to have the acknowledgement to check your credit score, and it's going to have certain disclosures. And I've had instances where business owners don't read the disclosures. They just check, no, 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 and then we run the credit and we see that that perhaps there might have been a bankruptcy or some other situation where we have to backtrack, and that creates stumbling blocks in the application. So please read everything that a bank would give you to sign. Again, we're going to check your personal credit score. And we're going to, ironically, I'm going to talk about the business credit score because it's important. But on the individual, on the conventional side up, 252 million, we do not look at the business credit score. But on the smaller loans, we do, and that could prove pivotal on whether you get the loan or not. We request a debt schedule, which is, you have to list every credit card obligation that your business might have, every piece of debt that your company has. You have to list it down, the interest rate, the payment, the repayment schedule, and you could be asked to have a business plan, especially if the loan is the use of proceeds for the loan is going to be a deviation from the history of the company. For example, if you're going to go into a new market, you're requesting a term loan to build up your sales capacity, going from Connecticut to Massachusetts, which are two different markets. The bank could conceivably say, okay, we want to see in writing the rationale associated with that potential move, and we would call that a business plan. It's a longer term, time frame for approval. It's usually 15 to 20 business days, and then there's usually some element of required due diligence after that. For example, a real estate appraisal, an environmental review of the property. And as long as those things come in at acceptable levels and information, then we would close within 30 to 45 days. So the 250 and under space, and pretty much all the banks around in Connecticut have this. It's a streamlined underwriting process. And what does that mean? If you were to go, we issue our applications, we don't have it on our website, and there's some banks do, but we have it. We want to pre-screen the opportunities before we, issue the link for the online application. When the borrower starts to fill out that application online, it goes through a pre-qualification stage, and we look at these are soft pull, and if you don't know the difference, a soft pull is really the bank accessing the credit information, your credit score, that was last issued to somebody else. So it's kind of like getting an older report, but it gives the bank an idea in terms of what your credit score, is going to come out to be. And then if you are pre-qual and you go through the process, we would actually do what's called a hard pull, where we would actually get the information, from your full credit report. And the 250 and under segment, we do rely on the business credit score. And if they're, aside from increasing your social capital throughout this process of obtaining a loan from a bank, please know your business credit score. There are multiple ways that you can find that out online. The SBA has been using the FICO small business scoring system for, I would say, like 20, 25 years. And the difference between the SBA and People's Bank, for example, on the streamlined underwriting, we do not create exceptions to these benchmarks. So if your credit score falls below 660 or your business credit score using the FICO small business scoring system is below 160, then you're not going to be pre-qual. There's no exceptions. So banks do not make exceptions under these streamlined underwriting processes. I would encourage you to find out what your business credit score, because it's been somewhat of a surprise to our borrowers as we unveiled this process, and I know it has been for other banks as well. And the reason for that is that your personal credit score has been very much statistically validated to a large degree based off history and the data that's in the repository. And these folks, Experian, Equifax, all these folks have done a tremendous job of trying to make it right, trying to get it right. We all know that we have mistakes sometimes on our personal credit score, but they're fixable. The business credit score has been somewhat fragmented, and hasn't led to that kind of consistency with the reporting of the information. So as such, like, you might have a very successful business, but a poor credit score because one vendor that you used happened to report that you were late for 2 to 3 months on a payment, but they didn't get any other scores coming in from your other vendors or your bank that you have a poor business credit score, and for some reason for that reason you're not approved for the loan. So we've had to do a lot of education around this. So I encourage you to look at what your number is.
We did get a
Yeah.
question from Andre Gutierrez, who's asking where can you go to check your business credit score?
So you can go to it's FICO, small business scoring system. You can go to Experian as well, Dun and Bradstreet. And I would go to the FICO one because that's what SBA uses. And let me circle back to that because it's important. The SBA does give exceptions on these benchmarks, on the personal credit score and the business credit score. And so if you're applying for an SBA and you would do that through a bank, not directly to the SBA, you would be, there are exceptions. There's ways to you can provide the explanation. There was a medical, I had a situation where my customer, unfortunately got sick and, had to step away from the business for 45 days. And, things didn't go as planned while he was away. And that lowered his business credit score. We were using the SBA, so we had the flexibility of the exception and getting that approved. If it wasn't an SBA transaction, then the cutoff would be, I'm sorry, but you don't qualify for this loan. So I would definitely use the FICO small business scoring system, especially if you plan to go SBA. And I'm advocating as an industry that we need to do a better job explaining to customers about the business credit score. The good news about the 250 and under space is that it's a quick turnaround time. It's 10 business days really is to close. You should get an approval within like 2 to 3 business days. And the loan documentation that comes out of this process is bank prepared. So no lawyers involved. If you are buying property or you're borrowing a lot of money from the bank, say $1 million, then most likely we're going to close that with an attorney that's going to prepare the loan documents. And so the closing costs for the 250 and above are significantly higher than the closing cost of the 250 and under. For example, our closing costs, we have a $750 technology fee because we actually use a company that provides the underwriting for the SBA also underwrites our applications on the online process. And so we have a fee that we're charged for every application. So we charge $750. We have like a $25 UCC1 fee, which is a lien on the business assets. And that's really it. So we do not charge annual fees. Some companies do charge annual fees on their lines of credit. And our lines of credit are structured as 3-year lines with a 5-year payout term loan at the end of that 3 years. So again, read your documents to know what the expectations are. So again, the 250 and under fast, low cost. The 250 and over is a little bit longer. A lot of investment by you from an information point of view. and is more expensive. The 250 and under is a prime based. The prime rate is typically measured by the Wall Street Journal Prime, and the spread on top of that is how the bank makes money. So our loans are prime plus 25 basis points up to could be 2%. So it's always good to shop around, and make sure you get the best rate and the best term for you. On the conventional side, we go out and we price our loans against the Bank Boston, the Federal Home Bank Boston Lending Advances. It's a huge acronym, but it's all banks are using it, and then we take that as a cost. For example, the 10-year money is around 5.1%, and we would add like a 2% spread. So your term loan and your commercial mortgage right now might be around 7 to 7.5%. That's how we price them out. So what do banks look at to get a yes? How do you get a yes? We underwrite, whether it's the 250 or under or above, we underwrite the same way. We look for 3 forms of repayment. First and foremost is the business cash flow. Remember that staircase. When you reach the top of that staircase, the bulk of the debt that you're applying for is going to be attached to the business assets. So we look at the free cash flow to support the monthly and annual loan repayment. We monitor by ratios. So this is again where your accountant could help you. Your EBIT is earnings before interest and taxes, and that's then divided by interest. That's called an interest coverage ratio. And a healthy ratio is 2.25 times above your interest payment. That's on an annual basis that we typically measure it. And then the EBITDA is earnings before interest, taxes, depreciation, and amortization. That divided by the interest expense and the principal payments, the payments that you make on all your debt, should exceed 1.2 times. These are ratios that are pretty standardized, bank to bank. They're adjustable. So when you receive something, don't think of it as a fait accompli. These ratios are negotiable, especially if like the first year, your projections show that you might be a little tight on the interest coverage, to request a lower ratio to benchmark it is appropriate, and banks will work with you. Over the long term, they do want to see 2.25 above interest and 1.2 times on your debt service requirements. So as long as the business cash flow is there, we move to collateral. Those are the assets used as a source of funds for the loan. So the lines of credit, we're looking at receivables and inventory. How we gauge that, we discount your accounts receivable by 25% or 20% in some cases sorry, it's my notifications. I thought I'd be able to prevent that, Ray, but I wasn't. Inventory, we discount it, sometimes by half. Your M&E depends on if you're buying used or new. We could go from 75% lendable value to 90% of the invoice value if you're buying new. And then on a real estate side, we're anywhere from 70 to 80%. So, what does that mean? Like if you're going to buy your building that's going to be owner occupied, we'll typically do 80%. So you're going to have to come up with 20% of a down payment to purchase that. So that's how we discount the assets. And why do we discount them? One, we want the equity investment in these assets to be there. We're partners in a transaction, right? You're an equity partner, you're the owner, and we're the debt partner, but we all have the same goal of helping you grow your company. And the other reason that we discount things is that there's going to be a cost to the bank to liquidate. If we have to take your receivables, we have to hire a collection agency to collect those receivables. They're going to charge us money, so that's why we discount our advance rates on assets to make sure that we include those costs. Third, and it is third, despite you have to go into it thinking it might be first, but it is third, and that is when you're a small business owner, 9 times out of 10 you're going to be required to sign a personal guarantee on the debt. And, um, that is because at the small business level, the the company and the personal debt and obligations and income are very much combined. They're hard to separate. And so the bank wants to know that if the loan goes bad, that the owner is going to help the bank to try to get the repayment, especially on the assets, so to speak, because the owner's the was dealing with the customers. So if the owner helps the bank collect on the accounts receivable, they're more likely going to do that if they have if you had a personal guarantee on it. So as you move up, as your company gets larger, it's interesting. So as your company gets older and larger, you start to you separate the business from the personal. What that is, that level, that's around $30 million in revenue, where you start to see no personal guarantees. So until you grow to that point, you're always going to have discussions with the bank in terms of a loan application, about the guarantee. You have the ability to negotiate step downs, as the loan is paid, maybe the guarantee goes down. If you have multiple owners in your company, you could base the guarantee based off of ownership. So if you own 20% of the business, you're responsible for 20% of the loan balance. So there's different ways to look at it. But as a small business owner for a long time, you're going to have, a personal guarantee attached to it. It's not a secured guarantee unless they ask for it, which I'll cover when I talk about the SBA. So your guarantee is an unsecured guarantee, which, obviously limits the ability of the bank to exercise its rights to attach to assets because there's no assets available. So that's why I say it's really a way for the bank to make sure that you still work with us in the event that we have to, liquidate the company. When you go and get an SBA loan, sometimes the SBA, depending upon the dollar amount, and I'll talk more specifically, they require a secured guarantee, which means that they'll have you sign a guarantee and they secure that guarantee with a second lien on your primary residence. So most guarantor agreements are unsecured, but you can't have a secured guarantee. How would the bank address that? If the business cash flow and the collateral coverage are not, great in terms of strength, then the bank might ask for a secured guarantee. But as long as the first two are in order, then, it's going to be an unsecured guarantee. So read your documents and have a lawyer close your loans. So we need help. Lenders need help because the mix of the economy has changed. Even in Connecticut, 20 years ago when I first got into the business, there were a lot of manufacturing companies. We all know, over the course of time, that manufacturing has gone offshore, and in its place, we've had tremendous growth in service-oriented companies. If you go to the collateral section, I mentioned hard assets, right? I mentioned a machine or a building. And then there was accounts receivable inventory, which are quick turning. But service companies typically lack the physical asset, equipment, or a building. So we need help to lend to those companies. And we rely on organizations like the Small Business Administration. There's a 7A business loan. There is a 504 program. These programs are designed to help banks extend credit to help a business owner grow in the hope that they hire people with the hope that it generates economic activity, in our local markets. The SBA is not a direct lender. I mean, during COVID, they kind of, did, and in some small cases they do, but by and large, they rely on what's called a preferred lender, like People's Bank, to fully underwrite an SBA loan and apply that guarantee to the loan. And the SBA basically is saying that People's Bank has been in the business for a while. They know how to do it. So we're going to let them underwrite it. And we have obligations under that agreement, but it makes it a little bit faster. But should you go the SBA route? In some cases, it can close, 40 days, but I've seen it also be 90 days. There is a very thorough process that you have to go through with the SBA. but it's a critical partner in the extension of credit to small businesses. I just wanted to put out there that, the SBA does require a second lien. If you're an owner of 20% or more of the business, and there is a collateral, issue with the business, then they might require a second lien. There's many rules and stipulations with an SBA, so I recommend working with an SBA lender. If you're at the chamber event and you see a banker, ask them if they're a preferred lender, and if they're not, then continue the conversation, but go find a lender that's a preferred lender. It will save time at the end. But the SBA, their loan sizes they're capped at 5 million. And the SBA fees can be very expensive. And there are SBA fees that the bank is charged as well in the transaction, and the bank cannot forward those costs to you on some occasions. So, it's expensive for us, but it's much, it allows us to do transactions that we wouldn't do. The 504 program is an amazing program. And I said to you, if you're a business owner, try to own your building. And if you can, use this SBA 504. They have preferred terms that are interest rates could be 1.75 to 2% lower in some cases on the mortgage for the property, and the repayment. So an SBA 504, they have a 20 or 25-year term with a 20 or 25-year amortization. So how would that work? The bank, and I'm doing a transaction right now where we're doing a 504. The bank is taking 50% of the mortgage, and we structured that as, a 20-year amortization. And then the 50% is the SBA is actually funding it, through a business capital development corp. And I'll show you some of those in a second. And that is a 25-year term and a 25-year amortization. And the interest rate is almost 1% lower. So, like, for example, we're at 7% on the first 50% of the mortgage. The SBA is at 6% on the second 50. So, if you're going to buy a building, I encourage you to look at the SBA 504 program. Other things, like I mentioned to you, and I'm sorry, just going on and on, but knowing the information. And one of those tidbits, if you're in an enterprise zone, you can go on the Connecticut Department of Economic Development website. And if your business is in an enterprise zone, and you can kind of benchmark it too, that pretty much a lot of the urban centers in Connecticut and the old industrial regions of the state of Connecticut are enterprise zones, then, you could qualify for some loan enhancements, some tax incentives that could help lower the cost or even help with the repayment. And the banks are very, knowledgeable in terms of how to incorporate those things in your loan. So that just goes, again, it speaks to the, developing your social capital, getting out there and, expanding on your contact base as it relates to the extension of credit. And then when it comes time to do your application, you'll know a lot of it. You'll have the information prepared, and that increases your ability to actually, get the lender to say yes. So we have a very active partnerships in our state for, alternative lenders. HEDCO, great organization. The Connecticut Small Business Boost Fund, the CEDF organization. The 50, so the CEDF and the Community Investment Corporation and BDC Capital are those 504 program companies. They're business development centers through the SBA, and they're also a great source of information and an alternative lender. Many of these organizations do microloans, for like $25,000. So I would encourage you to go on their websites and look at their offerings. And also take advantage of elements to help your business, not just from funding perspective, but from an operational perspective. I can tell you that if even on a tax return, we can tell the quality of the tax return. We want 2 to 3 years tax returns. And for example, if the line items don't match up year over year, anytime that you cause the bank to take a breath and say what's going on, that decreases your ability to get the loan. So investing in your partners that are going to help you prepare those financial statements is such a huge, huge investment, and I highly recommend it. It is expensive, but it could, lower your borrowing cost and the ability you could get that loan because your financial statements are, up to date and good quality. So tips, if your credit score is below 660, there's a bunch of credit counseling organizations, in the state. Get it above 660, both from an SBA perspective and a lot of the banks in terms of their streamlined underwriting process. Start to separate your business from your personal cash flow. I will tell you with the form of your business, you know, with how easy it is to become an LLC. I'm not a lawyer. I'm not giving you legal advice. But as a banker, it's easier to extend credit to an LLC than it is to a sole proprietor. So I encourage you to look at that and make that change with your tax advisor and your lawyer. And then, you know, you might have to provide some clarification. And this is a normal process. For example, I have a lot of landscapers in my loan portfolio, and they buy a lot of equipment, and sometimes they use vendor finance. And so I will see, on their personal credit report the loan for the backhoe or something like that. And I'll have to have the conversations, with the business owner saying who pays for that. Is that net? Do you pay for it after your either salary or business profits, or does the business pay for that as a normal course of your accounts payable? So you need to be prepared to know your credit report and know if there are any obligations that you need to explain. Again, knowing your business credit score, your FICO SBSS score, and it used to be free, but now you have to pay. But it's worth the initial investment to find out what it is, and then look for ways to improve it. I will say that your banking relationship is one of the most important factors in that, and in terms of what are some issues that we see that impact that is overdrafts, for insufficient funds. Those are things that, late payments on like a business credit card, those things in your banking relationship that could lower your score. Start building your social capital now, being a part of this presentation. Follow up with me. If you're a business owner, or somebody that is looking for a business loan, my email was on the first slide, provided in the chat. I love talking to people and learning about their business and what they want to do with their business. Plan ahead. If you know you're going to request a loan, then plan for it. What I always say too about, if you're a business owner, the worst time to ask for a line of credit is when you need the line of credit. And what I mean by that, banks by their nature don't like to be rushed. So like if you come to a bank and you say, I'm applying for a line of credit, I needed to close it yesterday, then that's a red flag. So, plan for this. If you're having a strong year with your business, go apply for a line of credit and have it open. And, it could be there when you need it, as opposed to asking for it when you desperately need it. So that's, another tidbit. Again, invest in your professional partnerships, your accountant, lawyer, insurance, the SBA score program. The SBA and folks like HEDCO provide a lot of excellent services, for your company. Watch your personal debt to income ratios. Again, they still, because they impact your personal credit score. And it still is a factor on the small business loan. And then, don't give up, just because you might be denied. And the bank has the obligation to explain why you were denied for, the extension of credit, even on the business side. Use it as a learning event, and address that issue, whether it's your personal credit score, your business credit score. Could be not enough for a down payment on a commercial mortgage. Worked for other ways to address that issue. So don't give up. It's a journey. And certainly I'll leave with this. we're not the cat's meow in terms of we're at the top of this, the staircase. It's a prize from the perspective that your business, made it to the level of obtaining credit from a conventional source of lending. And that's a great accomplishment. I think 35% of the small businesses don't make it to the fifth year. So the fact that you've made it to the tranche where you get access to conventional financing is a feather in your cap, and you should be proud of that, because we know how hard it is to own and operate a business in today's day and age. So that's the end of the presentation. There was a lot of information. You have my email. Please contact me anytime. Like I said, we do a poor job of explaining the rationale of our business in terms of how we approve things or decline things. And a lot of the information in terms of other resources just isn't widely disseminated. That's why it's going to take a lot of time for you to get to where you want to be with a business loan. I'll take any questions. Go back to the first slide with my.
Any info potential grants?
Thank you for that question, because I did not address the different kinds of banks. People's is a community bank. So we, as an organization, are required, but from our mandate, to reinvest in our communities. I think it's between 5 to 7% of our net income. So we do have the ability to provide grants to small businesses and to not-for-profits in our marketplace. So anytime that you go to a community bank, they're going to have the ability to do grants. The other organizations that are associated with the alternative capital space, they might have grant opportunities. Again, that's why I go on the websites, look at the offerings, and find out what it entails. Grant writing is also a specialty that a lot of small business owners and large business owners, for that matter, don't have the ability. So even Googling, there's some expertise out there for people that have written grants for other organizations that you might have to invest in that professional for a period of time to write the grant. But there are available grants out there for-profit and not-for-profit businesses, and the community banks are a great distributor of that form of capital to the marketplace. That's not to say that a Bank of America doesn't as well. It's just we're mandated to, and so and we really, like, our bank really tries to reinvest into its local community, whereas Bank of America is a national bank with that full geography needed to be covered, whereas People's Bank, we're a Western Mass and Hartford County bank, and we're going to put our money to work in those areas. Great question.
Any other questions? All right, well, thank you so much, Mark, for all this important information, and thank you for everyone online who was able to make it to the seminar. And for those who are watching on YouTube, I hope you got a lot of information out of it as well. And I'm going to give people 3 minutes back in their day. All right, thank you, everybody.
Thank you, and best of luck, everybody.